In this video, we're going to look at provision, contingent assets and liabilities in terms of IAS 37. We're going to look at the recognition, the measurement of provisions, and then how is contingent liabilities different to provisions. Okay, and we're also going to look at contingent assets, what those are, and then also the disclosure around contingent assets and liabilities. We're going to start off with a summary. Okay, a summary of IAS 37, highlighting the important concepts of this standard. It's a nice overview of what you need to know about IAS 37. We're going to start off with provisions, and this is where this will introduce this topic very nicely because it deals with something very familiar, and that is the definition of a liability. Now, IAS 37 says that a provision is a liability of uncertain timing or amount. So it already identifies a provision as a liability. So it says, in essence to us, that, listen, a provision meets the definition of a liability as contained in our conceptual framework. Okay, so it is a present obligation as a result of a past event that will lead to the transfer of economic resources. So there's no question mark around a liability. It is a liability. The question here is around the timing and the amount. And this is exactly what distinguishes a provision from other types of liabilities. Let's just think about a trade creditor, for instance. A trade creditor is by definition a liability. But there's no uncertainty regarding the timing or the amount because you do get an invoice from the supplier, and on that invoice is the amount that you need to pay and also by when, like for instance within 30 days you need to make payment. So there's no uncertainty regarding timing and amount. But with a provision there is uncertainty. So you know you have an obligation. It's probable that you will pay. So all of that is there, but you're not sure when or how much. Okay, so the recognition is an issue, the timing, and the amount. So the measurement is an issue, and that is where the question mark is. And for this reason, IAS 37 gives us guidance when dealing with provisions. It tells us, well, you can recognize this provision in a statement of financial position when you meet the 4 recognition criteria, and those are: there must be a present obligation as a result of a past event, where the outflow of economic benefits are probable, and you should be able to make a reliable estimate of that amount. So if you meet those 4 criteria, you can recognize the provision in your statement of financial position. So let's stand still at each of those criteria. A present obligation. So that is, in essence, the part of your definition of a liability. So there should be an obligation. And we said there's no question about that. That is not where the problem is. This present obligation could be a legal one. Okay, so in terms of a contract or by the operation of law, or it could be constructive. Okay, so this is something that arises because of circumstances. It seems that I can't spell constructive here. Constructive means that there's past practices, there's management policies, it creates an expectation, for instance. So it's part of this obligation arises because of certain circumstances that has set the scene for this to be an obligation. Okay, so it could be legal or constructive. It should be as a result of a past event. So there should be something that actually triggered this to be an obligation. Okay, and then the outflow of economic benefits should be probable, and this is very important because this is also part of your definition of a liability. Okay, so it's probable that you're going to make the payment, so that is not the issue. Okay, so it's more likely than not that you will make the payment. So it sways to the side of it's likely that more than likely that you're going to pay. Okay, so that is a given. when you're dealing with a provision. Okay, and then obviously a reliable estimate should be made. Now, this could seem to be a paradox because we said that there's uncertainty about the amount, and then suddenly we say there should be a reliable estimate. But remember, this reliable estimate simply means that to your best knowledge, to your best judgment, you can estimate this amount. So it's not that there's absolute certainty. No, there's still uncertainty. But you should be able to put an amount to it that is actually reliable. Okay, so there is still an amount of uncertainty here. Now, when you meet these 4 criteria, you can recognize a provision in your statement of financial position. Okay, the IAS 37 also tells us to be careful where we deal with outflow of economic benefits that will happen over a period of time or after a certain period has lapsed, because there could be a discounting factor there where we need to present value that amount. Again, that's very typical, for instance, where you have to raise a provision for restoration costs. So at the end of the asset's life, there should be restoration to the environment or something like that. So because that happens after a few years have lapsed, you have to discount that to a present value. So that present obligation has to be discounted to a present value, and you actually have to use the pre-tax rate for that. Okay, so just remember that when dealing with provisions. Okay, that this should be a present value where you're dealing with longer type of provisions. Okay, then there's specific guidance regarding onerous contracts and restructuring provisions. And the reason there is because the amount could be a bit unclear, and IAS 7 wants to give you guidance about that. And sometimes the timing regarding these restructurings is an issue. When do you bring in the provision? So let's first look at an onerous contract. Now, onerous contract is where the unavoidable cost of meeting your obligation in terms of this contract is greater than the benefit you're receiving from this contract. That is an onerous contract. Okay, so you're actually out of pocket at the end of the day, okay, because of this contract. And because you're out of pocket, we call it an onerous contract. So the question here is around amount. So it's not if it is a provision. An onerous contract should be recognized as a provision, but the question is at what amount? And IAS 37 tells us, well, that should be the lowest of the cost to fulfill the contract, so remaining in the contract until the end and meeting your obligations, or the cost to exit. So to use your exit clause to get out of the contract, there could be a penalty associated with that. That penalty is a cost to exit. So choose the lower of. So choose the lowest of the cost to fulfill, the cost to exit, and that is the amount, the currency unit of your provision. Okay, then regarding restructuring, and this is where management has a plan to change the business, to sell certain parts of the business or business units, there could be obligations that come with this restructuring. Okay, obligations that we have to meet. And the question here is, well, when does that obligation become a provision? Okay, and most of the time you'll see in questions or scenarios that are given to you in a test or an exam that management announces the plan to terminate or to change the business, to restructure the business, and an expectation is created to the employees or to suppliers or third parties that there's going to be a change associated with this business. And therefore, when that plan is announced and that expectation is created, you end up with a constructive obligation. So it's not necessarily legal. It could be legal as well, but it could also be constructive. And it says specifically that we need to look at that. Okay, so when a plan is announced, an expectation is created, watch out, there could be a constructive obligation leading to the recognition of a provision. The amount, be careful there because IAS 7 gives you guidance regarding this. Highlight these paragraphs nicely in IAS 37 where it tells you that you can only include in the amount of the provision direct expenditure for the restructuring. Okay, so you cannot include expenses that are part of the ongoing operations. Just a side note here as well, that when dealing with restructuring, always remember that IFRS 5, the non-current assets held for sale, and IAS 37, impairment of assets, could also be applicable when dealing with a restructuring. But that's just a side note, okay, for our students. Okay, so that is our provision section. And to summarize it, you have a liability. That is not the issue. The issue is regarding when to recognize it and at what amount. So all of this will happen. It's just when to recognize it and at what amount, or at what amount. Okay. So how is that different to a contingent liability? Now, with a contingent liability, we don't actually have a liability. Okay, which is an element of our financial statement. So we don't have a liability, and for that reason, we don't recognize it. We only disclose it. So per definition, we're not dealing with a liability as outlined in the conceptual framework. And if you just look at how it is defined in IAS 37, you can see it does not meet the definition of a liability. So the definition is in two parts for contingent liability. The first part is it could be a possible obligation. So already it falls out of the definition of a liability with this word possible. Okay, so it's possible. Okay, it is not that you do have an obligation, it is possible, you're not sure. So it will only be confirmed in the future, and there's something that's not in the control of the entity. Okay, so we don't have a present obligation. So already no liability here. Or we could have a liability here. But the problem is with the rest of the definition to say, well, the transfer of economic benefits are not probable. Okay, so again, it falls out of the definition of a liability. Or the amount cannot be determined. So as you can see, here's a lot of uncertainty where you're dealing with a contingent liability. So there's a lot of uncertainty. So a lot of uncertainty here regarding the outflow of economic benefits and the amount here. So even though there might be an obligation, the rest of the criteria is fuzzy. Okay, we don't know if we're going to have this outflow of economic benefits and if we can measure it. Okay, so as you can see, the difference between a provision and a liability has a lot to do with this degree of uncertainty. Whereas with a provision, there's a liability, but there is uncertainty about the timing or amount. But the probability of outflow of economic resources are there. Okay, so that's not an issue. But with a contingent liability, there's a lot of uncertainty regarding the outflow of economic resources or the amount. Okay, and for this reason, we only disclose it. It's important information for our users. They need to know about it, so we do put it in a note in the financial statements, but we don't recognize it as an element of the financial statements. Okay, so a contingent asset is the other side of the coin. It's where we deal with the inflow of economic benefits, but it's only a possibility, so it's not a certainty. So we have this possibility that we will receive economic benefits, but it is not too sure. Okay, and it is as a result of a past event, but we're not sure. It will only be confirmed in the future. But where it is virtually uncertain that we will get the inflow of economic benefits, we don't even think about disclosure there. We just ignore it. But where there's a possibility, we have to disclose it as a contingent asset. Now be very careful. IAS 37 talks about the reimbursement rights. Now these reimbursement rights is basically, it's tied to our provision. Where we have a legal obligation, okay, to make a payment or to transfer economic resources to another party. Okay, so we have no choice. We're going to settle this amount with the party. but we have recourse. We can go to an insurer or to another third party and claim that amount back as a reimbursement. Just think about a doctor, for instance, where they could be involved in some claim from a patient for damages, but all doctors are insured. So in a case where they have these claims that could be huge amounts against them, they have the option to then claim that from an insurer. Okay, so that insurance payment is a reimbursement right. Now, you need to evaluate that and see if it does not meet the definition of a contingent asset. So there could be a possible inflow of economic benefits to you because of the fact that you have to meet this legal claim. If it's only possible, it's a contingent asset. But where they tell you it's virtually certain that the insurer will reimburse you for this claim against you, then it is an actual asset that you have to recognize in your statement of financial position. Take note, you're not allowed to set off this reimbursive asset against your provision. So you cannot net it off in your statement of financial position. However, the expense as a result of the provision could be netted off against the income that you receive from the insurer in your profit and loss. Also remember that all of this could have your provision side of this could all have tax implications, so you need to consider the deferred tax consequences of your provisions. So don't forget about the implications of IAS 12. That summarizes your IAS 37, and we're going to continue in our next sessions looking at it in more detail through examples.